Welcome to this explainer. Today we're tracking a massive, ongoing chain reaction that's completely reshaping global markets and quite literally your own portfolio. It all kicked off with a sudden, forceful policy pivot from the Federal Reserve, and right now we're watching those dominoes fall across every single major asset class.
I want you to seriously consider this question. Is the era of easy money officially over? For years, right, we've all been conditioned to just buy the dip. We trusted that central banks would always swoop in with rate cuts and liquidity, but with inflation surging back up to 4.2%, which is the highest we've seen since 2023, and a brand new regime over at the Fed, well, that safety net might be totally gone. Actually, the era of easy money might not just be on pause, it might be dead. And that fundamental shift, that's exactly what's driving the wild macroeconomic volatility we're living through right now.
So here's our roadmap for today. We're looking at 1, the Fed's hawkish pivot, 2, the great market rotation, 3, small cap debt danger, and 4, the July 14 catalyst.
Let's jump right into part 1, the Fed's hawkish pivot.
Under our newly appointed chairman, Kevin Warsh, the whole inflation narrative has deteriorated, and I mean fast. Just a few months ago, back in March, the Fed was projecting PCE inflation to be a super manageable 2.7%. Markets were actively pricing in multiple rate cuts, but wow, by June, that projection had skyrocketed to 3.6%. Confronted by war-related energy shocks and really sticky core inflation, the central bank got slapped with a massive reality check. They entirely abandoned their dovish stance. So instead of cuts, we're now staring down the very real probability of 1, maybe 2 additional rate hikes before the year is out.
And this perfectly illustrates a profound structural overhaul at the Fed. Chairman Warsh is bringing a totally different philosophy to the table. Get this, he actually became the first Fed chair since 2012 to withhold his personal dot plot estimate. That signals some serious humility about just how uncertain the economy is right now. He's also effectively killed off the market handholding we used to get with forward guidance. The policy statement stripped down to about 100 words of pure hard facts. He even launched internal task forces just to audit how AI is impacting labor and productivity. The bottom line here is that the Fed has shifted to an uncompromising, highly data-driven posture. They're prioritizing fighting inflation over protecting equity portfolios every single time.
Which brings us to Section 2, the great market rotation.
That dramatic shift in monetary policy we just talked about, it triggered a massive reassessment of market leadership in June. And you can clearly see a stark divergence playing out. On the losing side, we've got speculative tech and those overextended Magnificent Seven stocks. Now sure, companies with genuine AI ecosystems, like NVIDIA, they're still holding a premium. But the broader, speculative, growth-at-any-price tech names, they're just getting hammered. Higher discount rates are absolutely crushing their distant profitability horizons. But on the winning side, capital is flooding into long-neglected value sectors. Financial services are roaring back, mostly because banks make more money from higher interest rates through expanded net interest margins. Healthcare is seeing a huge influx, thanks to its defensive stability and predictable dividends. And utilities? They're getting a massive dual boost. They offer high yields in a choppy market, and they directly benefit from the immense power grid demands of all those new AI data centers.
I absolutely love this quote from Intellectia AI because it perfectly captures the market psychology right now. They note, "The shift from growth at any price to quality at reasonable price is a hallmark of late-cycle investing." Investors today are demanding cash flow, bulletproof balance sheets, and realistic valuations right now, not just promises of profits a decade down the line. Fundamentals actually matter again.
Let's move on to Section 3, small cap debt danger. Now, this recent rotation we just discussed has pushed a ton of capital into small cap stocks, giving the Russell 2000 a nice jump. But hiding just beneath that impressive surface performance is a ticking time bomb, 31%. Right now, a staggering 31% of EBITDA for companies in the Russell 2000 is being entirely eaten up by interest expenses alone. That is the heaviest debt servicing burden these companies have carried in at least 6 years.
The reason this burden is so terrifying right now all comes down to debt structure. Large cap companies, think your standard S&P 500 giants. They generally term out their debt for years at fixed rates. Only about 7% of their debt is floating. But small caps? Nearly 30% of small cap corporate debt is sitting on floating rates. That means their borrowing costs aren't locked in safely. They reset based on whatever the Fed decides to do next. So when the Fed hikes rates or even just hints that rates will stay high for longer, small cap balance sheets feel it first, and they feel it the hardest.
So the really crucial question here is this. What happens if economic momentum starts slowing down, but rates stay stubbornly high? If wage inflation or slowing demand compresses profit margins even a tiny bit, that massive interest bill doesn't shrink with it. And with nearly 40% of the Russell 2000 already operating unprofitably, they have zero cushion. None. If a shock hits, a huge chunk of this index could face truly devastating consequences. The upward momentum is real, for sure, but so is the immense precarious leverage sitting right underneath it.
Which leads us to our final domino, Section 4, the July 14 catalyst. Every single tension we've unpacked today, the Fed's new hawkishness, the great rotation out of tech, the perilous state of small-cap debt, it all hinges on one specific moment. Tuesday, July 14th at 8:30 a.m. Eastern Time. That's when the June CPI inflation data drops, and it is the ultimate climax for the market's immediate future. If we go down path A and the print comes in hot, say it holds at or above 4.0%, well, that completely validates the Fed's hawkish pivot. The odds of a September rate hike will probably push towards 65%, Treasury yields will stay super elevated, equity multiples will aggressively compress, and that small-cap debt bomb we talked about, it ticks a whole lot louder. But what if we go down path B? If we see a soft CPI print below 3.8%, the whole mechanism reverses. It would act as a massive relief valve, dropping yields and giving the upcoming earnings season some much-needed room to breathe. And this event, it's particularly explosive for precious metals. Why? Well, because the Fed is incredibly divided right now. The FOMC is currently split 9-8 on whether to hike rates again in 2026. One single inflation report could swing that entire consensus. A hot CPI keeps real yields high, which heavily pressures gold and silver spot prices. But a soft CPI could immediately compress those yields, rapidly bringing institutional targets like JP Morgan's $4,500 Q4 gold target right back into reach. Though, it's fascinating to note that the big structural buyers, they're just ignoring this volatility altogether. Regardless of what CPI does, China's central bank just added another 14.93 tons of gold to its reserves in June. That marks their 20th consecutive month of buying. They're playing a long, multi-year game that's totally independent of whatever the Fed's July data says.
Which leaves us with this final, provocative thought. The S&P 500 has this incredible 11-year streak of posting positive returns in the month of July. But with prices already running way ahead of foreign earnings and a premium valuation that literally leaves zero room for error, everything is resting on a knife's edge. One bad inflation print on the 14th could unravel that historical momentum faster than a decade of history can repair it. The penalty for bad data has simply never been higher. So, will the streak survive, or is this domino effect just getting started? Thank you so much for joining me for this explainer. Keep a close eye on those numbers on the 14th, and I'll see you next time.